Hello, welcome to the first in a series of e-seminars on tax-proofing your portfolio. My name is Rick Cross.
And I'm Ron Bergman.
Together we are co-founders of American Premier Financial Group, a wealth management firm located in Holbrook, New York. Our client base consists mostly of successful professionals and independent business owners throughout the U.S. who find themselves in the upper income tax bracket. For these individuals, Roth conversions may be a smart decision. Of course, they should examine all the facts with their tax advisor before racing out to change their portfolio. But with our strategy of financial hindsight, which we'll get into a little later, individuals that are age 50 and over need to take a serious look at this concept. One of our more sought-after services is helping clients reduce the effects of taxes on their portfolios. Being familiar with the current tax laws and knowing how to use them can help tremendously. In today's current environment, with trillions of dollars of government debt and potentially an even larger deficit due to future government obligations, tax rates appear destined to climb to higher levels. So please invest a few moments of your time today to learn about this new tax change and how it may have a huge impact on your family's financial future.
One answer may be to pay your taxes now to potentially receive tax-free income for you and your beneficiaries later. This may seem counterintuitive, but consider for a moment the direction that tax rates may be going. This is why a Roth conversion may make sense. When first introduced in 1998, Roth conversions were limited to those individuals earning less than $100,000 a year in total income. For many of the people that were eligible, paying upfront taxes from savings wasn't a real option. Roth conversions involve taking an IRA, 403b, 401k, or any other qualified retirement plan and paying the taxes now. The concept requires that you hold the Roth IRA for 5 years or age 59 and a half, whichever is longer. Any growth from interest, dividends, or capital appreciation would be yours for the keeping without any further taxes being imposed. Effective January 1st, 2010, everyone, regardless of income levels, can now take a portion or the entire amount of a retirement plan and convert it to a Roth IRA. They will have to report the conversion as income for 2010 and pay taxes on the amount converted. If the account grows in size and marginal tax rates increase, savvy investors will be pleased they took advantage of this strategy. In addition to conversions, taxpayers who receive earned income from wages and self-employment income can contribute up to $5,000, $6,000 for those over 50 into a Roth account. Although you receive no tax deduction, a Roth IRA account does grow tax-free.
Based on the IRS tax rates published in 2007, a married couple earning $70,000 and converting an additional $70,000 from a traditional IRA to a Roth would pay federal income tax at a marginal tax rate of 25%. Now, providing one follows the rules governing a Roth IRA, the account would grow on a tax-free basis, and any withdrawals are tax-free as well. Now, here's where the assumptions start. There is no guarantee this scenario will materialize, and past performance is no guarantee of future results, but hypothetically, let's look at a case study where your Roth IRA has doubled in value over 10 years. In addition, let's assume that an individual's tax bracket increases to a 35% level. In this scenario, the Roth owner has been benefited tremendously from the conversion. A $140,000 Roth IRA account with a tax-free benefit would translate into a savings of $49,000 in taxes. The Roth IRA owner, however, would have been responsible for paying $17,500 in federal taxes at the time of the conversion. This tax must be paid from other sources, such as savings, and should not be taken from a traditional IRA being converted for this program to truly work. Now, if the owner was to pass away after conversion, his children would receive the proceeds free of federal and state income taxes. Providing the Roth owner has the cash available or a viable plan to raise the money needed to pay federal and possibly state tax on the conversion, the above example supports the concept of converting a traditional IRA to a Roth. But what if the market was to decline significantly in the first year of conversion, much like what happened in 2007 or 2008? The taxpayer might be subject to paying a tax on what we commonly refer to as phantom income tax. This is where our program of financial hindsight may make sense. Now, the IRS allows taxpayers, for whatever reason, to change their mind before the filing date of their return, which is typically the April 15th of the following year. One idea is to open up several different Roth accounts with separate disciplines, such as a large cap growth, small cap growth, and an international stock fund. Below is the performance of 4 different indices as of December 2nd, 2009, as reported in the Wall Street Journal the following day. Year to date, the S&P 500 had gone up 22.8%. The S&P Mid-Cap rose 30%. The NASDAQ Composite climbed 38.6%, and the International Stock Fund, the MSCI, rose 29.7%. So now let's assume someone age 50 has $400,000 in traditional IRA money and wants to convert half of that to a Roth in order to lock in today's tax rates and take advantage of roughly 15 years worth of potential tax-free growth. We recommend opening up 4 separate Roth accounts and placing $100,000 in each one of them. At the end of the year, we meet with the clients to review their accounts and decide which, if any, of those accounts we'll keep and which ones we'll take advantage of and recharacterize back to a traditional IRA. Now, in the above example, the NASDAQ stock index provided the highest year-to-date return, with the mid-cap being the second best performer. We would then recommend changing the S&P 500 and the Morgan Stanley Capital Index International fund back to a traditional IRA with no taxes due except on the 2 accounts we kept. Now, should we experience a worldwide market decline, we may advise recharacterizing all 4 IRAs back to the traditional IRA status.
Now, this does not lend itself to making a decision in 5 minutes. We suggest meeting with our clients, reviewing their options, and along with their tax advisors, deciding whether this makes good financial sense. Our 30 years of experience each allows us to suggest what, if any, change to your retirement account is warranted. Our suggestion is to act now to receive this information so that Financial Hindsight is up and running for you at the start of 2010. Please feel free to give us a call at 1-800-889-3914, extension 112, or visit us on the web at apfinancialgroup.com to learn more about Roth conversions and other programs designed to tax-proof your portfolio.